Okay, lecture note: detailed analysis of the Constellation Energy and Capital deal. Let me magnify. Okay, New York, January 10th, 2025, Reuters. U.S. nuclear power provider Constellation Energy on Friday agreed to buy privately held natural gas and geothermal company Calpine Corp for 16.4 billion, one of the biggest acquisitions of U.S. power industry history. The cash and stock deal. So, in order to buy this company, Calpine Corp, Constellation pay both cash and stock. So, combination of cash and stock. So, it's the cash and stock deal. The cash and stock deal comes at the time of rising electricity demand, driven by the proliferation of energy guzzling AI data centers and the electrification of transportation, EVs, and buildings, which are expected to hit a record this year, including that the transaction valued Calpine at okay 26.6 billion. Okay, so they sell this at this price, but well, if you acquire a company, you have to pay their debt. Okay, so the transaction value is this one because they have to bear that. So it means that is about 10 million, right? Because it is the cash and stock, and then they acquire that. So there is a difference between this one. The difference is that the Constellation should pay. So overview of the deal: transaction participant buyer Constellation Energy, the largest producer of the nuclear power in the United States. Seller Calpine Corporation, a leading generator of electricity from natural gas and geothermal sources. Seller's ownership. Now, for the seller, Calpine Corp, private equity firm called Energy Capital Partners. So they are behind it. ECP and co-investors. So basically, it is this private equity firm, Energy Capital Partners. They are selling Calpine Corporation to Constellation Energy. Now deal value 16.4 billion including net debt. Okay. Equity breakdown is okay. In order to pay this one, well, they pay only okay. Do you have here? Yeah. Do you no. So only 4.5 billion in cash. Okay. In equity breakdown, and then it includes 50 million share of Constellation Energy subject to 18 months lockup period. So it is a cash stock combination, cash equity combination to finance this one. So in order to pay this one, first give cash 4.5 billion and give 50 million share. But when they give share, okay, the buyer, this private equity firm, they cannot sell those share Constellation Energy right away. They have to wait about 18 months for various reasons. Okay. Valuation metric. So Calpine valued at approximately 8 times is forecasted 2026 EBITDA, earning before interest, tax, differential amortization. It is comparatively lower than sector average of 12.3 EBITDA for the industry top 3 player. So it is low price. So seemingly it is a good deal for Constellation because they pay low price. Potentially it is a bad deal for Calpine Corporation or Energy Capital Partners because they sell a low price, 8x. Then we can investigate the background of this one. Okay, well, remember it includes this equity value. Therefore, after the deal, if this equity increases, the value of this equity increases, then maybe it is good for Energy Capital Partners, right? If it is a good deal, remember, if it is good deal to the buyer, then buyer's stock price would go up. Then this seller has this buyer's share, right? So if buyer's share increase, it is also good for sellers. Maybe that's why they sell at low price. Okay, let's take a look at background and strategic context. Market trend: rising demand for electricity driven by artificial intelligence, AI, and energy intensive data center. So increased focus on low carbon energy sources. So what would be the rationale for the deal? For Constellation, its strength is low carbon energy portfolio by combining nuclear, which is sound Constellation, with natural gas and geothermal asset of Calpine. Therefore, for Constellation, it enhances its position in energy-intensive markets like Texas and California. How about the seller, ECP and co-investors? It provides a profitable exit after taking Calpine private in 2017 for 5.6 billion in cash. So they bought the company at 5.6, right? So after around 8 years, they sell like 3 times. Okay. So despite selling at a discount to peer, the deal structure enabled them to benefit from constant potential upside. Again, if it is good deal, cheap deal for Constellation, its stock price go up, then it is good for ECP. Moreover, if this kind of a strategic synergy, realize again, then ECP can benefit. Okay. Key deal details: transaction structure, equity consideration heavily weighted in Constellation share, reflecting a partnership style exit. So it is like a partnership style exit, not just cash, receive cash and buy. No, they receive stock. By receiving stock, basically they become partner at least 18 months. So it is 18 months lockup period on the shares, ensures alignment interest with ECP and Constellation. They have to work together to make synergy happen out of this deal. Okay, if the stock price go up, both of them are happy. Valuation and alternative exit route. IPO option: higher potential valuation but limited liquidity. Likely 15-30% of corporate equity could be floated through IPO. It would require pricing share at a discount to attract investors due to lack of a long public history. Or strategic sale, low valuation, but immediate liquidity and operational synergy. Maybe therefore, that is why ECP choose strategic sale instead of IPO option. If they choose IPO option, go public. Okay, if they make Calpine go public, and then maybe they can sell the shares in the market and exit. However, higher potential valuation through IPO. Usually IPO is the best valuation, but well, limited liquidity. Okay, they cannot sell entire, only 15-30% corporate equity. If they sell all, it will be very bad signal to the market. Okay, then it's still market shock. If owner of the company sell its entire share, well, why owner sell the share? Maybe it is bad company. Well, then market heavily discounted, or maybe there are regulatory reasons. Okay, so if it is not IPO, if they want to exit for remaining parts, they have to attract investors, other investors. Then anyway, it is similar to now become strategic sale, or they have to find other investors. So instead of doing this one, partial IPO, and then through IPO, sell partially in the market and partially to the other financial or strategic investor. Maybe that's not good idea, so they sell a strategic sale. Okay, strategic sale. The market reaction is that Constellation share, buyer's share low 24% post announcement, indicate market confidence in the value creation from the deal. So instantly, ECP instantly made 24%. by receiving share of Constellation. Okay, usually in M&A, after M&A, usually buyer's share drop, but in this case, buyer's share increases because of potential synergy and deal structure. What is the implications and lessons for alternative investment? For private equity exit, illustrate the need for flexibility in exit strategies. Emphasize the trade-off between valuation maximization and liquidity. How soon I can get cash. Okay. Strategy shows importance of strategic partnership. Alignment with a strategic buyer can unlock synergies and long-term value beyond immediate cash returns. Retaining equity in the buyer provides exposure to future growth if synergy happens. Now it also reflects the sector-specific dynamics. Energy sector's transition toward a low-carbon solution is reshaping valuation benchmarks and strategic priorities. AI and digitalization trend create new opportunities for energy producers. Very simple financial analysis. ROI, return on investment for ECP. Initial investment was 5.6 billion. So exit value approximately 4 times their original equity investment. Now potential value creation for Constellation is the synergies not explicitly disclosed but significant value anticipated from operational integration. Now it positioned to meet growing electricity demand in key states. Now broader implication for alternative investment strategy, adaptability. Private equity funds must balance maximizing returns with market realities. Partnership model. Deal structured with equity retention can align incentives and provide exposure to future growth. Now sector focus. Understanding sector-specific trend, e.g. AI-driven energy demand, is critical for successful deal making. Question and discussion and question. They are the question you can think about. Was Calpine undervalued in this transaction? Why and why not? How does retaining equity in Constellation benefit ECP and its co-investor? What are the risks and opportunities for Constellation in integration Calpine? Compare and contrast an IPO versus strategic sale as exit strategy for private equity firm. Conclusion. The Constellation Calpine deal exemplifies a strategic and flexible approach to private equity exits. While aligning with market trend and leveraging a strategic buyer, ECP successfully navigated the challenges while Constellation enhanced its growth potential in the evolving energy landscape. This case offers valuable insight into deal structuring, valuation, and broader dynamics of alternative investment.